Hello class 12th, welcome to the online tutorial sessions for economics. This is Avinash Lambert, your economics guru, and today we are going to continue our 7th chapter, which is excess demand and deficient demand, under which we are going to cover a new topic, which is measures to control excess demand or inflationary gap. Now students, you have already studied what is excess demand and what is inflationary gap. What is excess demand? Excess demand is the situation at the full employment level where aggregate demand is more than aggregate supply. I hope you know this. Now there are two types of measure which are taken to control this excess demand. You know the reasons and you know the effects. Now how to control it? Now there are two methods, which is fiscal measures and the monetary measures. Under the fiscal measures you will study about the taxes, you will study about the government expenditures, and under the monetary measures you will study about the control of money supply, right? Now measures taken by the government to influence the income of people of the economy, those are known as fiscal measures. Under the fiscal measures, the methods, the steps taken by the government to control the income of the people, those are known as fiscal measures. Now measures taken by central bank of the country to influence money supply, they comes under the monetary measures. Fiscal and measures. Fiscal, under which the central government try to control the income of the people, and under the monetary measure the central bank tries to control the money supply of the people. So they both are different. Now we are going to start with the fiscal measures. Under the fiscal measures we are going to start with the taxes. Now what to do with tax to control the excess demand? We increase the tax. To control the excess demand, government may impose additional taxes or increase the existing taxes, which will decrease the income of people of the economy. If you are going to give more money to the government as tax, then you will be having less savings, and if less saving, then you won't be demanding much more products. So that's how the government tries to control the excess demand. Now with the fall in the income of the people in the economy, their purchasing power also decreases, and consequently the aggregate demand will also be decreased. So that's how increase in tax work. The second thing is government expenditure or public expenditure. Now what they do? The government decreases their expenditure. The government expenditure or public expenditure refers to the expenditures taken by the government in public interest, like expenditure on public facilities like hospitals. If the government have started to decrease their expenditure on the health or education, then it's like that they are decreasing the public expenditure. If the government will reduce the level of expenditure or public expenditure, then these expenditure will be undertaken by public from their own account. It will result in the fall of income of the households. For example, the government is providing us free medical facilities. We are not paying a single rupee on that. Now what if the government stops expending that money on public health? Now we have to expend, we have to bear that expend from our account. So that means the money which we were saving from the health expenditure, now we have to pay from our pockets. It means we have to pay more now. Are you getting it? So that's why if we are spending our money on health, so we are saving less now, and if we are saving less now, our purchasing power is decreasing, and ultimately we are going to decrease our demand, that is aggregate demand. With the fall in the income of the people of economy, purchasing power of household will decrease, and consequently the aggregate demand will also decrease. I hope you have understood. Now we have completed the fiscal measures. Now it's time for the monetary measures. Now under the monetary measures there are qualitative and quantitative measures. Firstly we are going to start with the quantitative measures, and students, you have already studied these quantitative measures in the central bank as the functions of the central bank. Now it will be very easier for you to recall if you just revise those functions of central bank, that is the control of credit function. Now let's start with the quantitative measures. The first quantitative measure is the bank rate. Now if the central bank increase their bank rate, then in that case what will happen? If the bank rates are increasing, then the money supply is going to be decreased. Why? Because if bank rates have increased, then the people have to give more interest rate as loan. Why? Because the bank rate, the commercial bank has to pay more money to the central bank, and if they are going to pay more money, then they will cover that money from the general public in the form of higher interest rate, and then we are not able to, we will not be wanting to have the loans, because those loans are at very high interest rates, and that is not attractive to the general people. Now what is bank rate? Bank rate is a rate at which central bank of the economy provides loan for long term purposes to commercial bank, at long term to the commercial bank. Now if the central bank is charging higher interest rate, if the central bank is charging the higher interest rate, the commercial bank have to cover that, have to recover that from the general public, and this will discourage the public to take loans, and money supply in the economy will decrease. With the decrease in money supply, the purchasing power will also decrease, and so does the aggregate demand. Bank rate will increase, money supply will go down, and if money supply is going down, purchasing power will also decrease, and so does the aggregate demand. The next one is increase in repo rate. Now what is repo rate? Repo rate refers to the rate at which central bank of the economy provides loan for short term purposes to commercial bank. Now if the repo rate will increase, then the commercial banks will get loan at higher rates of interest from central bank, and consequently commercial bank will also charge the higher rate of interest from the public against the loan. It is just equivalent to the bank rate. Bank rate and repo rate are both the same thing, but there is single difference that bank rate is for long term purposes and the repo rate is for short term purposes. Are you getting it? So both, if we increase both, then the commercial bank will be recovering their loss of reserve from the general public in the form of increasing higher rate of interest, and that high rate of interest is very unattractive to the general public, and they will not be taking loans from the commercial bank, and thus their purchasing power will decrease, and so does their aggregate demand. Now the next one is reverse repo rate. You already know what is reverse repo rate. Reverse repo rate refers to the rate at which central bank borrows. Here the central bank is taking money from the commercial bank for short term purposes. Now if the reverse repo rate is increasing, commercial bank will get more interest on deposit with central bank. If central bank is providing more interest rate to the commercial bank, then commercial bank will be more interested. They will deposit their more money with the central bank to get more rate of interest, and in that case their reserve will be decreasing and they won't be able to give the loans to the general public, because most of their reserve has already been to the central bank. Fine. So if the reverse repo rate is increasing, then it means money supply will also decrease, and so does the purchasing power, and because purchasing power is also decreasing, it means aggregate demand will also decrease. Now the next is increase in cash reserve ratio. If the central bank increases the cash reserve ratio, then more money, more reserve will be kept with the central bank and lesser amount will be kept as reserve by the commercial bank. And again, if lesser cash reserve is with the commercial bank, then they won't be able to give more loans, or if they are going to give loans, then they will be at very higher rate of interest. So if the cash reserve ratio is increasing, it means money supply will be decreasing, and so does the purchasing power of the general public, and their aggregate demand will also decrease. Now what is cash reserve ratio? Cash reserve ratio is that portion or that fraction of the total deposits with the commercial bank have to keep with central bank as reserve. I hope you have understood. Now the next one is increase in statutory liquidity ratio, that is SLR. If SLR is also increasing, then also if SLR is increasing, commercial bank have to keep higher amount with itself as reserve, and as the rest availability of amount for public loans with commercial bank will decrease, right? This will decrease the money supply in economy, and consequently the purchasing power of the economy, of the people in the economy, will also decrease. Now with the decrease in purchasing power, aggregate demand will also decrease. Fine. So if the SLR is increasing, it means money supply will be decreasing, because now commercial bank has to keep more amount of money with themselves, so they are not able to provide loans. Then in that case money supply is decreasing, and purchasing power of the general public is also decreasing, because they are not able to get the loans from the banks, from the commercial banks, and so their aggregate demand will also decrease. Now the last one in the quantitative measure is the sale of securities, that is open market securities. Under the open market operations, it is the process, there is a process of buying and selling of government security in the open market in order to increase or decrease the amount of money supply in the banking system. Now in case of excess demand, if there is excess demand, then RBI will sell the government securities, so that money available with the public or the bank will be transferred to central bank. They will sell their securities to the central or to the commercial bank, and commercial bank will give the money and buy the securities. So in that case the money with the cash reserve with the commercial bank is decreasing. Why? Because they spend that money in buying the government securities. Their money is now with the central bank. Are you getting it? And if their money is with the central bank, then they are not able to give loans to the general public, or if they are able, somehow they are able to give loans to the general public, then that will be at higher interest rate, and the higher interest rate will never attract the general public. So if there is sale of security, then the money supply will decrease and purchasing power will also decrease, and so does the aggregate demand of the public will also decrease. So students, these are the quantitative measures. Now it's time for the qualitative measure, and there is only one qualitative measure which you have to study, which is margin requirements. You already know what is margin requirements. I guess you already know that. Now increase in margin requirement, in order to control the excess demand or inflationary gap, the central government, they increase the margin requirement. Now what is margin requirement? Margin requirement refers to the rate of discount determined by the central government from which securities provided by borrowers or discounted for the balance loan is provided to the borrowers. In easier language, the amount of security, the amount of collateral security is being increased. Suppose for the loan of 1 lakh rupees, they are taking 1,20,000 as the collateral security, but now they have increased the collateral security to 1,50,000. Then in that case people will have to give more rate of interest, and they will be discouraged to take loans now. So if they increase the margin requirement, then it will affect the money supply, and the purchasing power will decrease, and so does the aggregate demand. With the decrease in the money supply, purchasing power will also decrease, and there will be decrease in the aggregate demand also. So I hope I am very clear to you all, and I guess you have learned the qualitative, the quantitative measures, and you have also studied the increase in tax and the public expenditure. Basically you have studied about the measures to control the excess demand or inflationary gap, under which you studied two measures, that is fiscal measure and monetary measure. Under the fiscal measure you studied about the increase in tax and the decrease in government expenditure. Under the monetary measures you studied about quantitative and qualitative, and under quantitative you studied that increase in bank rate, increase in repo rate, increase in reverse repo rate, increase in CRR and increase in SLR, and also the sale of securities. And in the quantitative measure you studied about the increase in margin requirements. Now students, just note down all the things which were written in the captions so that you can complete your work by today only. Now students, that's all for this video. Stay home, stay safe and see you soon.